Sean Peche of Randmore Funds. You've been pretty active on LinkedIn lately, not least Novak Djokovic being a value investor, or certainly similarities there, Sean?
Alec, I just had a bit of fun. I watched the Wimbledon final last weekend, and I was intrigued to see how well Novak kept his head, and just thought about it more broadly. You know, he did what he felt was the right thing. He at cost to himself, you know, by not participating in the Australian Open. He came from a set down. He is not often the crowd's favorite. And so I just got to thinking of the similarities between himself and value investing, and had a little bit of fun with an article. And as with all articles, as you know, they develop as you start with a little idea, and then it just expands. So not everybody's cup of tea, but I amused myself for a bit.
Not always the fans' favorite. That is value investors, but right now, value investors have got to be the fans' favorite.
I think year to date, so far this month, it's been quite challenging. We've seen a pullback in oil, the oil price, a lot of commodities, some of the banks. And in fact, it's been an interesting week last week on Wall Street, because we had some of the big banks report, JP Morgan, Morgan Stanley, Citigroup. And they had some interesting things to say. And, Citigroup was up 13% on Friday. So it's been a tougher month for value investing. And I think one of the main reasons is we saw the inflation print at just over 9%. And everybody thought, right, okay, that means the Fed is going to raise rates by maybe 75, 100 basis points, and then we're done. Then inflation's over, it's behind us, and we can go back to buying our growth stocks. And I think that's how some people are thinking. That's the narrative. I don't try and guess what the Fed's going to do. And I think trying to guess what the market is going to do on a day-to-day basis and how the market might or might not think is a very dangerous game. And I'll give you a perfect example. Just last week, the S&P was, if you sold the S&P, so with S&P last week, okay, if you sold the S&P on Wednesday morning after JP Morgan's news, you were down 4% on the week. But if you held through that, you were down 0.5%. If you bought on that JP Morgan news, you were up 3.8. So this is in 1 week. So you can just see if you get your timing wrong, if you're trying to guess what the market is or isn't going to do. It's okay, JP Morgan's going to have bad news, let's sell, all the banks are going to be a disaster, and then next thing on Friday, Citigroup's up 13%. I think it can be very dangerous. And there's a lot to worry about out there. And in many cases, we've got to worry about the Chinese property market, we've got to worry about Europe, whether Russia turns the gas off on Nord Stream. Well, it's off at the moment for maintenance. Does it come back on? What is the earnings season going to do? There's a lot to worry about if you want to worry, but to try and guess what the market is going to do on a day-to-day basis is a dangerous thing. And so it was an interesting week last week. A couple of weeks ago, the Chinese tech stocks are doing all right. Last week, Alibaba's down 15% on a cyber hack, and now talk of a fine by the Chinese authorities. So these are interesting times indeed.
Lots of news flow that affects prices of big companies, as you've just mentioned, that data leak at Alibaba. Who knows what that's actually going to cost them at the end, quite apart from the reputational risk. But I suppose the big news last week was it was the beginning of the quarterly's earnings season, the reporting season. Why is this such an important time, the reporting of quarterly results from the American companies?
I think it's important because it gives investors an insight as to what's happening on the ground, rather than us just sitting behind our spreadsheets and guessing what's happening. You get companies talking about the state of the economy and talking about inflation. Is inflation, what is happening with inflation? I mean, we had Pepsi last week. They reported. They said for the balance of the year, inflation is going to be higher than the first half. We had Conagra reporting. They said their operating income was down 25%. They're expecting low teens inflation for the next year.
What do they do, Conagra?
So Conagra, it's a big food company, meat processing, and they've got a whole lot of brands and things like that. And then So those are the food companies right on the ground at the coalface. Of course, what's happened is for many months, they have insulated us from passing on that inflation because they get the inflation, then they pass it on to the retailers, and the retailers have to pass it on to us. But there's always a bit of a time lag. And so there was some question last a couple of weeks ago with Tesco's and Kraft Heinz, where Kraft Heinz tried to pass on some price increases to Tesco's. Tesco's says we're not having that. And finally they came to an undisclosed resolution. And so those kinds of things, especially now, what is the consumer doing? So that's why people are looking at the banks. I mean, all of the banks, JP Morgan's earnings declined 27%, US Bancorp 23%, Citigroup 23%. And broadly speaking, investment banking is down. And one of the reasons there is because it's harder to close the deals because interest rates have gone up and banks don't want to lend. They're a bit more concerned about whether they lend to a company to make a big acquisition at these prices. All right. I mean, we saw that a little bit with Tesla and not Tesla, with Elon Musk and his takeover of, or tended takeover of Twitter. So just going back to the banks, you saw higher net interest margins, obviously because the banks are earning more interest from their customers. But against that, and credit card data has been quite positive, but against that, they are concerned about what the outlook is. And so they're creating higher provisions for bad debts. And of course, you've got asset management, and asset prices are down, so asset management fees are down. So that's why all those banks' earnings are down. But it's quite interesting to see a stock like Citigroup rally 13% on Friday when its earnings were down 23%. And why is that? Well, it's on 7 times earnings and it's on 0.6 times book. And so maybe it's got to the point where all the bad stuff's in the price. I mean, I don't know. We don't own Citigroup. We've got many of the European and some Japanese banks. You look at JP Morgan, it's on 1.5 times book, and US Bancorp's on 2 times book. And if there's going to be a recession, it's going to be worldwide. And why do I want to own a US bank on twice book when I can own a European bank on half book? So that would be the simple things. Yeah. So that we're looking for signs as to what's happening on the ground.
Sean, did you ever work with Koki Koiman?
I did. I had a great pleasure of working with Koki at Old Mutual in the early days.
I thought you had. That's why the question is, what would Koki have thought about those initial results? Because he's been so bullish on banks.
Yeah, I don't know. And actually, when I was preparing for this, I thought he'd be a great guy to get hold of and ask him, because he'd have some more deep and meaningful insights than me, Alec, I'm sure. But I think it is interesting just looking, the bank valuations reflect the valuations. The disparity between US and elsewhere in the world is the same for banks as it is for other companies. I mean, a classic case, Pepsi's on 27 times earnings. It's historic earnings. Its long-term average, 15-year average is 17 times. You can buy some consumer staples companies here in Europe on 12 times. But I think Koki'd be a great guy to speak to.
Well, it's an interesting view, given that he is so excited about the value that banks are offering, and the disparity between JP Morgan, which came out and its share price went down 3.5%, and then, as you say, Citigroup's share price went up 13% on its numbers, and yet they were about the same on the earnings line.
That's right, except the one is much cheaper than the other. And Citigroup is more international. JP Morgan's a bit more focused in the States. And but I like financials. I think they're a great place to be. If you search for the word inflation in banks' earnings, conference call transcripts, you will see less reference, or fewer references to inflation than if you search for inflation in consumer staples companies. And we're overweight. Yeah, so here at Rand One, our global equity fund, we're overweight financials.
And interest rates, when they rise, that's good for banking profits.
Typically it is good, but because they borrow short and lend long, so it's the interest, the gap between the short-term interest rates and long-term interest rates is quite a key factor. The one interesting thing about the US banks is that they have been far more aggressive on buying back their shares historically than the European banks, because the European regulators wouldn't let them because of the pandemic. And now we're at the point, and I'm going to get a bit technical here, but because interest rates have risen in the States, bond prices have fallen, many of these banks owned bonds in their portfolio, and so they have had losses on that section of their portfolios. And so that means their capital cushion is less. And so they cannot, so most of them have paused their buybacks. They've halted their share buybacks. And they've done so because they have a lower capital cushion if we now have a recession, which you'll need a capital cushion if you have a recession. Interestingly, the European banks didn't buy back at the higher price to books or previously because the regulators wouldn't let them. And so it could take advantage at much lower prices. And so that's one of the reasons we prefer the European banks.
Really good stuff. Thanks for unpacking all of that. Now, next week, we've got Netflix, which we've discussed before, and Tesla, which is probably the most widely held US stock among South African investors. Have you had a chance to look at those two, or do you have any thoughts on what we can expect from them coming out later this week?
So I haven't really, Alec, but I've got a couple of, off-the-cuff thoughts. I mean, Netflix international business, I think it's 60% of their business is offshore. About 30% of that is euro denominated. And of course, the currencies, the euro is down 15% against the dollar over the last year. Sterling is down about 15%. The yen is down nearly 20% on a year ago. And that is going to be a problem for Netflix. So they're going to face a currency headwind. Presumably, they would have paid for their content in dollars, their head offices in dollars. Now you're losing on the revenue. And we know from the last time they reported that they were losing subscribers. So you're going to have fewer subscribers paying less in dollar terms. There's lots of competition about with Apple Plus and all of that, and Peacock and Paramount. And so they can't really raise prices. So I think earnings are going to be challenged. I think it's going to be more on what they say at their results. And there's a rabbit that they can pull out the bag, and that is advertising. So they might say, right, well, we've got an advertising solution. We're now going to have a different tier to try and attract some of those people back. And so that is probably what people are going to look to. I think if they don't say anything on advertising, it's going to be a problem because then people are going to extrapolate those results. That would be my guess on Netflix.
They've disappointed twice. And on the first disappointment, many shareholders dumped it. We held on at BizNews in our portfolio. On the second disappointment, we dumped. If they have another disappointment, the potential surely is for Netflix's shares to take another big hit. And in the previous 2 quarters, those were sizable, 30% plus.
Yeah, they were. I mean, you're going to get to the point where at some point there's going to be capitulation where everybody just throws in the towel and gives up on it. And sometimes it's after the third disappointment. Sometimes it's, fourth or fifth. But pressure will ramp. And so they'll pull a rabbit out the bag, I guess, at some point. But we don't own Netflix and yeah.
And probably very happily so, given the fragility of that stock at the moment. You did say that it was worth about $80 billion, so it's still a lot of value in there, or a lot of price in there. And you didn't mention Amazon Prime, which is something that I've been watching closely because Amazon Prime's videos are getting better and better all the time. So it's almost like these big giants, Amazon and Apple, coming in more and more into the Netflix space.
Alec, there's an interesting concept, and I need to do a piece on this on LinkedIn. And it is, trying to forecast demand is very difficult. So a lot of value investors try and forecast supply. And what you often find is that if there has been a huge amount of capital thrown at a particular business or industry or whatever, that means that down the line returns are going to be lower. Okay. And that is what we have, because competition is there. And that's what we've seen in this streaming segment. Apple is throwing capital at it. Disney, we've had Paramount, which, some mergers. So there's lots of Amazon. So there's lots of money going into the space. What does that mean? It means it's going to be increased supply. It means it's going to be lower returns. Look at food delivery, Deliveroo and Just Eat and all of those things. A lot of money has gone to that space. So, one I think always has to be a little bit careful of rushing the goalie on areas where there's been a huge amount of capital spent, because it'll take a while for things to play out and settle down before you can make an attractive returns.
The other big one for this week. Tesla, your thoughts there?
So Tesla, I mean, I haven't looked at Tesla recently. I know that there's, China's going to be a challenge. That's quite a big market for them. They've been locked down. There's obviously this distraction with what's going on at Twitter. I think if I were a Tesla shareholder, I'd want to know from Elon Musk what on earth his intention is. Isn't this a huge distraction for him? Is he going to be embroiled in a lengthy and protracted legal court case to try and save 44 billion? So, yeah. And then, of course, you've got startup costs in Germany at the Berlin plant. What's happening to natural gas prices in Germany, or electricity prices in Germany, is a big factor there. So startup costs, my experience has always been that when people get excited about new factories and new plants and new operations, startup costs always take away some of the gloss early on, and that you find that the costs are higher than you expect because the ramp is slower. And so you're not capitalizing things. And so I wouldn't hold my breath too much on Tesla. I think the potential for downside surprise is probably greater than upside surprise.
The point you made a bit earlier about capital being thrown at a new industry, and in this case with electric cars, and that the returns over time as a consequence of that capital being thrown at it being lower. Is there a similar risk overhanging Tesla?
I would think so. I mean, and it's not just new entrants. You've got the Neos and Lucids and Frisk and all these other car companies, but you've also got the incumbents, the BMW and Mercedes-Benz. And look at what's going on at the moment. They're about to IPO Porsche separately, and so all the big incumbents, Nissan and Renault, they're all moving into the EV space. And so that's probably going to mean, whereas Tesla's had the market to itself. So I think you can draw the same parallels. It's always quite interesting to look at that.
Sean, quite a few value investors have been enjoying a great run with resources shares here in South Africa, but that's reversed. Now, last month, I think it is, when you and I were having a chat, you warned that metals prices had gone into a bear market. But my goodness, after having a look at the share prices of Anglo American, Sibanye, Stillwater, some of the other BHP Billiton, some of those international metals companies that are listed on the JSE, a lot of them have halved since March. Are they now getting to value area, or are you a bit spooked by this too?
Well, I mean, different commodities are driven by different things. So, for example, the coal price hasn't halved. Copper's down 30% from its highs. I think nickel's down about nearly 70% from its highs, although those highs were somewhat artificial because of the short squeeze that we had in nickel earlier this year. Platinum and palladium, well, that's driven by auto sales. And auto sales are going to be soft, and there's some concerns that the EV market is ramping faster. And so maybe gasoline and diesel sales are going to be slower. So that's probably weighing on platinum and palladium. Obviously, the rand is giving those companies some sort of respite. But what's interesting is that some of the data I've seen is that you get commercial traders. So that would be companies, car companies looking to buy platinum and palladium, and you get non-commercial, which are the speculators, the hedge funds, the CTAs. And there's some data to suggest that some of those commodities have been aggressively sold by the non-commercials. And so that's the traders getting out. I think one of the worries at the moment is this Chinese property market. There's a bit of a wobble going on there. We've seen Evergrande, and I see today that China's trying to stabilize the property market by stalling repayments and mortgages. Lots of Chinese people have bought properties and then found that the prices are now substantially lower. And so what happens in the Chinese property market could be quite meaningful for the commodities. But every time there's a cycle, it's always slightly different. This time with the metals, compared to last time, we've got ESG and we've got wind farms and solar and all those sorts of things. We've got battery powered cars. Those things use nickel and cobalt and copper. And so we didn't have that last time in the cycle. So, you got to look at it. Different companies have different dynamics. Some are more exposed to iron ore. Well, that's going to be a different one to, so that's where the active management makes sense, Alec, because each company has its own dynamics, and one needs to look into those. So, we don't have Glencore. We took profits at Glencore quite well. We are overweight oil companies, and so something like Total has pulled back quite meaningfully. That's one of our largest holdings in the fund, and is now at the same price I think it was in September 21. But September 21 in dollar terms, but in September 21, the oil price was 80. It's 100 today. And refining margins are nowhere near what they are today. And so, that company looks to me to be on like 4 times earnings. And so there's always a case of when you get these innocent bystanders. That's what I like to think about them. Okay. And go in a market route, go find the innocent bystanders, the ones who are just thrown out with the others. There are some companies that deserve to be down. But the innocent bystanders, those are the ones you want to look for.
Total's an interesting one just to close off with from a Southern African perspective, because I believe that the Mozambican investment, the biggest investment ever in Mozambique, the Total LNG operation in the far north that was suspended because of the military activity that went on there, that they're coming back in again, and it's starting the early stages of startup once more. So that's good news. And there's other parts of the world where Total is also going into natural gas in a big way. So is that the reason why the shares are under pressure, that it's investing heavily into the future right now and maybe not generating as much profit as shareholders might want today?
Oh no, I think it's just caught up in the oil prices downsell all oil companies, and I think that's particularly good news that the Mozambique is hopefully it's not all dead and buried there. Total are a major player in LNG worldwide, and as we know from what's going on in Russia and Europe trying to wean itself off Russian gas. LNG is a big market, and everybody always thinks of Shell and Qatar and all the rest. Well, Total's also a meaningful company, but people don't really want to own oil companies. And so we always like to ask ourselves, why is a stock mispriced? Well, it's mispriced, we think, because people don't want to own oil companies. They prefer to own the tech companies that they believe are greener, even though the likes of Amazon generate 60 million tons of CO2 a year. But that's the perception. But Total is one of the few oil companies that didn't cut its dividend. So I think that's good news, and they're also a large company in renewables. I mean, they bought 50% of SunPower, the large solar power company, years ago. In fact, we owned SunPower at the time, and so they were an early mover in this whole renewable space. LNG and renewables and oil and refining are a big. They're each important parts of their business. It's not just oil.
So if we were to add a wild card into our portfolio, we could do worse than Total.
Well, I would think so, Alec.
Sean Peche from Randmore Funds. We'll be following that one closely.